My name's Jeff Molepske. I am the Director of Business Development for Black Label Capital. We're located in Plano, Texas, lending over 30 something states. Obviously, our biggest footprint's always going to be Dallas, always going to be Texas based off of where we're at. But like I mentioned, we lend worldwide, or not worldwide, nationwide. And we do hard money lending primarily for fix and flips or rehabs, ground up construction's our main focus area. We might dabble every once in a while a little something different. Standard is 1 through 4 residential home or 1 through 4 units, but we can do some 10 and 12 units and those sorts of things. And that's kind of our bread and butter there. So a little bit about Black Label Capital. Our owner and founder was a Marine sniper. He got out of the service, came back from being overseas. He flipped about 30 houses and said, "Man, I like flipping houses, but the finance side of things kind of excite me." So that's when he opened up Black Label Capital and started doing the funding side of things. So we were founded in 2018, and Tim and I have a heavy background in mortgages. I think he's got about 30 years. I've got about 14. If you want to know about drywall, I'm not the person to ask. If you have questions about mortgages, Tim and I are the ones to ask. So with that, Ryan, I know you've got a screen here to tell a little bit about your company and how you came into doing what you do, but take a minute and introduce yourself, and we'll go on to the next screen there.
Yeah, absolutely. So my name is Ryan Otto. I'm the president of Accent Financial Services. I've been in the world of finance and accounting for the last about 25 years now. Accent Financial has been around for a little over 30 years. It was started out here in Wiley, out on a farm, and it was just a guy who liked figuring out how to save taxes, started helping his farmer friends and neighbors figure out how to save taxes, and he built it into a whole firm. I took it over a couple of years ago, and we've been having a lot of fun since. So
awesome.
yeah, so our big stuff is tax strategy, business strategy, and the best strategy that we can recommend to people out there is real estate.
Perfect. Well, that's why this is a natural marriage for us to have this presentation and kind of go from there. Tim, you want to skip to or move forward to the next tablet there, and we'll have lots of questions. And interesting that it's from Wiley. We have a handful of people that do loans, or they flip houses, and they're on these super modern houses, and one of the guys happens to be from Wiley, and he's a great client of ours. And he said, "Man, I like the modern, but I had to do some Wiley touches." And so he's got like the sliding glass or sliding barn door somewhere, and he's got some wood in grain, and he's like, "Man, I'm country. I'm a country boy from Wiley, and that's kind of my specialty." So nice to be in the same county and be in the same metroplex. All right,
Yeah.
and Tim, you want to move one more forward there? All right. I think we did already go over the part there.
Yeah, pretty much.
Yeah. All right. There we go. All right, Ryan. The screen that's up says real estate and business, and then real estate professionals and real estate investors. We'll let you go.
Yep, absolutely. Yeah, so again, like one of our big things is real estate, but there's a couple different sides to it, right? So something that's a little bit interesting for this year is there were some changes in the Texas real estate laws, and it's made some opportunities for real estate agents and real estate professionals to act a little bit more like businesses now, which is pretty cool. And your biggest two tax advantage situations is to own and invest in real estate and to own your own business. And your real estate strategy is really kind of two different people here. So there's the real estate professionals who now they can have a business. They've always had an opportunity to get sort of advantaged tax tax advantaged investing in real estate. Now they can also take advantage of business stuff. And then you've got the real estate investors, and there's a lot of different ways of investing in real estate, and depending on your situation, it's going to cause you some different kind of tax situations depending on what it is you're trying to do. So I thought we could kind of talk about both of those things. Real estate professionals it's a special category. It takes some work to be classified in the eyes of the IRS, to be classified as a real estate professional. And we can kind of talk about I think I've got a slide later on that talks about some of the important things to become a real estate professional. But the cool new thing for this year is now real estate professionals and real estate agents can now own their own business and take advantage of a business strategy that we call the S Corp strategy. And so we'll get into that. I think we'll tackle the real estate professional side first, and then we'll talk about some of the things on the investing side.
Okay. So Tim, you want to move it to the next screen? There we go.
Awesome.
I was just about to ask to give me a heads up when to go. I don't want to get too far ahead.
Yeah, no.
We're perfect right where we're at.
We're perfect. Exactly where we're supposed to be. So real estate professionals and LLC. So the LLC got started not that long ago, actually. And you think about, the history of businesses, and businesses have been with us for, the beginning of time, right? But the LLC, which is the most popular business structure now, it hasn't existed since before 1977. The thing that happened this year is real estate agents are now able to operate as an LLC. And that's fantastic for them, because now they can actually be a business. They can be organized as a business. They can do all of the things that they usually try to do and just have to plug it into a Schedule C when they're doing their taxes at the end of the year. And everybody keeps all their receipts and writes down on their notepad, like, here's the stuff that I did. No, so now you're going to be a real company, right? And so it's different for them, because basically this rule said the brokers can now pay a company as the real estate agent. So there's a couple of things that happen because real estate agents are now able to do this. The first one is they can be really organized. They can have some different types of branding and everything. It lets them operate a little bit more officially than it used to be, right? But it also opens up this S Corp strategy. And when we get into that, you'll kind of find, I think we can go to the next slide if you want. We'll talk about what the S Corp strategy is. There's a lot of words on there. Read through it if you'd like to, but I'll give you the short version, right? When you're a Schedule C, or when you're making money and somebody's giving you a 1099, you're going to end up paying what's called self-employment taxes. And it's a 15.3% tax on basically everything that you're making. And so the way that you handle the strategy is when you make a certain amount of money, and for us, we usually say when you get to about $100,000 in income and your profit is at least 40 or so, that's a good time to consider the switch, because it's the equilibrium between a situation where you're paying self-employment taxes on every dollar that you make, and the situation where you're paying payroll taxes and not paying self-employment taxes on everything after that.
Ryan, I hate to interrupt if you were on a roll, but just to clarify,
Yeah.
S Corp versus a Schedule C is kind of what you're comparing now? Or is it S
Yeah,
Corp and LLC?
so an LLC is a state entity.
Hmm.
And the state of Texas, where we're at, there is no real estate income tax, and it's the same thing
Hmm.
on the business side. Unless you're making $2.5 million, I think you're not paying
Hmm.
anything in the state of Texas, and all businesses are state entities, but you do have to pay taxes to the federal government. And there's
Hmm.
different tax classifications that you have when you have an LLC. So you can either run your LLC as a pass-through, which is saying, I'm going to do business as this and I'm going to put it on a Schedule C and it's all under me. Or you can run your LLC as an S corporation, which
Yeah.
says, I want to be taxed like I'm a corporation.
Okay.
And so you kind of imagine the difference between those in your mind is sort of a formality kind of a thing, right? Like I could just put it on my taxes as a Schedule C and it's not a big deal. I'm just recording a couple of things.
Hmm.
Or I really want to act like a company. I want
Okay.
to do all the stuff. I want to have payroll. I want to itemize every expense that I have and have a full-blown P&L and a balance sheet and do the whole thing, right? And there's pluses and minuses to doing either of those, depending on where you're at in life and sort of what the situation is.
Hmm.
The cool thing about LLCs is you're able to switch from being a pass-through entity to being an S corp. And so what we usually do is we recommend people, you start with an LLC, you keep it as a pass-through, you start doing your books and everything. And when you get to a certain amount of money, you say, okay, now I want to be treated as an S corp because there's some advantages that are going to come
Hmm.
along for that with.
Well, and that I guess that's part of one of my questions. So, as a business lender, we lend to either type of entity. And so 95% of ours, no matter of our clients, end up having an LLC. And what I don't think they realize is that maybe they should move to the S corp. But we had somebody that closed in a corporation, and it was his first deal ever. So I was kind of, not that we can't close in the S corp, but I just wanted, I was kind of curious. So, but just to reiterate, it's the income level is kind of in the full time, or the amount of time you're putting in is kind of what directs you, I guess, is the way to say it.
Yeah,
Okay.
and there's a couple of things with that. So when you guys are dealing with people who are investing in real estate, and we can talk about the difference between rental real estate versus fix and flip
Hmm.
real estate versus commercial real estate. It's all different kinds of things, right? Um, Most of the time, you're when you're buying real estate, you want that real estate to be in an LLC for the protection of the LLC.
Hmm.
But you don't necessarily want your real estate holdings to be in an S corporation. And the reason for that is when it's when it's just an LLC, it's a pass through to you as a person, and you're going to do that as a Schedule E on your taxes, and you're going to be recording it as passive income,
Hmm.
right? There's other stuff that goes along with that, where if you have passive losses and passive gains, and you can kind of mix and match them together, right? And make your
Hmm.
tax liability maybe go away. Um, but when you have investment properties in an S corp, the S corp is really always going to be treated as ordinary income. So
Hmm.
it might not be as tax advantaged for you to have your real estate holdings inside of an S corporation.
Okay.
Yeah, but
Tim, does
as
that
an
make sense to
operational thing, I mean, having your everything that you're doing as a business,
you?
as an operation, having that switch into an S corp, it can save you a whole bunch of money.
Hmm. Hmm. Okay. Well, and then that's the threshold where I think some of our clients are at. They just, they're really good at, like, on flipping houses. They're really good at acquiring the properties, but sometimes the tax benefits on the backside are what isn't as clear to them, and where they should go. And hopefully they're tuned in so they could kind of understand some of the benefits here and know that. So
Yeah. Yeah. And so just to touch on the fix and flip thing a little bit, um, that income is pretty much always going to be taxed as ordinary income,
mhm,
right? And so in the real estate tax planning kind of a thing, the advantage of investing and holding in real estate and doing rental properties and stuff like
mhm,
that, it's a longer term tax play because you're going to get all of that income is going to end up being passive income. And
mhm,
you do your depreciation, you do the whole long-term strategy when you're holding real estate,
mhm,
but it's not as much cash flow in the short term. It's not as much cash flow as fixing and flipping, right? So you can go into a fix and flip project and make 60, $100,000 out of one project. You're going to end up paying full taxes on that because you're doing it, and the idea of doing it is you're trying to do it as fast as possible,
mhm,
right? But the benefits of real estate on the tax side come from spreading things out over a long time.
mhm,
That's what the power of the depreciation is all about, and it's what um the long-term cash flow from that comes from it is
mhm,
really for years down the road after there's no debt left on the property and it's just cash flowing, right?
mhm. Yeah. I didn't mean to sidetrack you. I didn't. I know you. It sounds like you're. I saw your presentation. I reviewed it. So if that's time for us to go to the next screen, we can.
Well,
I wanted to
I'm gonna
clarify.
Yeah.
can if you don't mind, if I can I sidetrack for a moment, I'm gonna for a moment talking too fast and maybe break this down of in terms of types of self-employment for dummies. And really get down to the simple thing. I know in our industry and most people listening, we're looking at most of our clients are into fix and flips. And of the fix and flips, they'll retain a couple. So they'll mix the things together. So they'll
Hmm.
retain a couple, and then they'll later on try and do a DSCR or some other type of loan for their long-term rentals. So if you were to look at them, if I were to sit back and say, hey, if I were underwriting a paper as an example, and I would say, let me see your income docs, let me see what you've got on it. I would probably see an S corp showing some fix and flips, the income and outgoing income from that, and then the Schedule E for rental income. So I'd see that mix of it.
Yeah.
When we're talking to people that are just looking to get into this industry, this is where they think this is the direction to go for their financial security in the future. What piece of advice? We're starting at ground zero. We know nothing. This is just we have some money. We think we want to do this. What advice would you say? Hey, here are the different ways you can set this up to help you. Here's how I would recommend and why. Like I said,
So
I was going to break it down to dummies. So this.
yeah, so the first thing that I would say is start yourself a business and start doing accounting for it. Because all of the time that it takes you to go find a property, you're driving around, maybe you're flying places, you're talking to people, there's a lot of stuff that goes into finding your first property, right? But all of that counts as business expenses. So start your business first. Make sure you're recording everything properly and just keep doing that. And as you add a property in and you take on the expenses and you put in the investment and you do all the work and you turn it around, all of that is great. And that's the stuff that's gonna make you all the money, right? But you're also running a business, and there's certain things that go along with that from a compliance standpoint that you need to make sure you take care of. And don't wait until, a year, 2 years down the road, and all of a sudden you're saying, hey, I gotta go pay taxes on this $50,000 that I made over here. How do I get rid of some of the $50,000 so that I can pay less taxes, right? And it's really easy to get into a situation where, because somebody's not giving you a W-2, which is what a lot of people are used to doing, there aren't taxes being taken out of this stuff. So right from the beginning, start acting like a company so that you can make sure you have your ducks in a row for later on. Yeah, so that would be my first thing I say. And just start with QuickBooks or something. It's a couple $100 a year that you can get an account to do that. It'll track your mileage. So, vehicle expense and driving around to these things, it counts. That's a tax deduction. And there's the QuickBooks mobile app will actually keep track of all your mileage for you. Like, that's great, because if you're ever going to get audited later on down the road, one of the things that they're going to ask you is, okay, prove that you did all this mileage. There you go, it's done, right? It's a lot easier to start acting like a company earlier than to try to pretend that you did it later on and try to put all the pieces back together.
And that's great advice. Getting proactive versus reactive.
Yeah, 100%.
I'm gonna go mute again, and then I'm gonna change the page.
Okay, let's go. Yeah, well, right. Okay, so speaking of deductions, right? So vehicle deductions, that's definitely one of those. So all of this kind of stuff you can do as a Schedule C. You can also do it as an S corporation. So if you're talking about people who you're just getting started, all of these things, they still apply. You can do all of this stuff. If you're not going to have a physical office, which most people aren't these days, you're going to do it out of your house. Well, there's a whole sheet about how to deduct your home office, the space that you're using in your house for business. Do it, take it. Every deduction that you can find is, at the end of the day, it's dollars and cents that you put back into your pocket, right? So, but the home office deduction is, over the last 5 years or so, it's gotten a bit of a bad rap. I think it was kind of oversold to everybody for a while, and nobody really understood what to do with it. So people started saying, okay, listen, it's causing a bunch of problems. Maybe just don't do it. Or I don't know how to figure out all this stuff. I'm not going to take it. And it's one of the top overlooked deductions for people, is you can have this home office expense, and maybe it saves you a couple of grand a year by doing it. So don't write it off as being complicated. It's not hugely complicated to do it. There's a special form that's made by the IRS to do home office deductions. The same thing with vehicles. And a lot of people look at this stuff and like, okay, I have these expenses for my vehicle. I went and got gas. Am I tracking my mileage? Can I use my payments? Can I do my insurance? There's a whole bunch of questions. I mean, it comes up in virtually every strategy meeting that I have with people, is, what do I do with my car? Can I write off my car? And you can, and there's a couple of different ways to do it. But make sure you do something with it. And particularly when you're out there looking for real estate, again, and this goes to both real estate agents and people who are investing, and you're going out looking at properties. Real estate agents are out there all day long working from their cars, right? Like, their home office is their car, basically. But you're traveling all over the place. You got to record it so that you can take that deduction for later on. A couple of these other ones. So health insurance, once you get started in this and once you have your own company, your company can pay certain, not all, it depends how you put everything together, but your company can pay for health insurance for you. That's great. Your company can pay for life insurance for you. It can pay for all kinds of things. And it's particularly beneficial to people who they're the only employee in their small business. It unlocks a whole bunch of stuff having a business. So that, like I said at the very beginning, there's two great tax strategies going into, like, how do I save money? Real estate and business. Your real estate agents are going to do all of these things, but your real estate investors can do a lot of this stuff also. All that it takes is you starting your business. And you might not be able to you're not going to have that much cash in the business at the beginning because you're looking for investments. And as you go along, you're going to be able to build up to some of these things. But something that's super cool is if you're getting out of the rat race and going down in real estate investing, real estate professionals, you're not getting a W-2. It also means you may not have access to health insurance anymore. You may not have access to 401k or retirement savings. Those things are available to you when you have a business. So there's a bunch of stuff that kind of goes into that, right? And if you sit down and you think about what you can put into a business, if you have questions about how do I do this, it feels like I should be able to write off this. Is it allowed? Ask a professional. The tax code is what is it, like 75,000 pages long at this point? There's a lot of stuff to it, but just ask. It's not a big deal for somebody who knows what they're talking about to walk you through a couple of these things, right? And this is going to save you money every single year. The S Corp strategy, if you're bringing in, I think, just rough math, if you're bringing in about $200,000 a year, you get to a certain point, you're going to max out self-employment tax, but that max is a lot of money, right? And if you can do the S Corp strategy and only pay yourself a portion of that, you're going to free yourself from up to a 200 grand, $17,000, $18,000 in self-employment taxes that you could save every year. And it's the same thing with all of these. And it works so much better as a company rather than just trying to do these things yourself.
All right. So quick question before we move on. So the first one is we have a client that he owns two businesses, obviously one fix and flip, and then he owns basically a retail shop. Can two different LLCs and two different industries hit that 200,000 and to become an S Corp, or does it have to be in the same line of business?
So depending on the situation, what you might want to do, and this is just throwing stuff out, right?
Mm-hmm.
You might want to have another business that controls all of them, and this one is your S Corp.
Gotcha.
And then the other ones are pass-through entities. And the reason that you would do that is because as an S Corp, you're required to take a paycheck from your company. But if you're taking a paycheck over here and paying payroll taxes, and you're taking a paycheck over here and paying payroll taxes, now you're paying a whole bunch of money in payroll taxes, and you're not going to save the self-employment.
Yeah. Okay, that makes sense.
Right.
And then the question we got now, this person started off last year and they thought, oh, I'll do one or two flips a year. Last year they met that goal. Well, this year they've already done 4, so their income, and they called it capital gains from the selling of, they flip the houses and then or they rehab the houses and then sell them, obviously, for a large gain. So that question is what sort of he suggested go buy a truck. So just kind of curious, when your goal is 2 a year and you've already doubled it and you still have 5 months left, what are the other strategies on that?
Yeah. Well, okay. So there's a bunch of stuff that you can buy
Mm-hmm.
to save on taxes. My biggest thing about that is don't buy stuff if you don't need it.
Yeah.
Right? If you don't need a truck for your business, like you've got a car, it takes you everywhere that you need to go. You don't need to go spend $80,000 on a nice truck. You've got transportation covered.
Mm-hmm.
Right. And we have a lot of people who have farms and they get to the end of the year and like, hey, I'm going to go buy a new tractor. I'm going to buy some new equipment. I'm going to do all of this stuff. Right. And yeah, you can, and it'll save you money on taxes, but then you just bought a whole bunch of stuff that maybe you don't need.
Mm-hmm.
So typically when I think about what can I buy to save on taxes, I'm not a big proponent of that stuff. I would rather, unless it's something that you need, I would rather take that and try to go stick it into some retirement accounts and save taxes on it like that. And when you talk about some of these small business retirement accounts that people can do, so there's a SEP, there's a solo 401k, you can do Roth IRAs, you can actually start yourself a whole regular 401k plan, right? There's lots of different things you can do. The really cool thing about being the only employee in a small business is you get special rules on your SEPs and your solo 401ks. So you could, if you've just got a bunch of extra cash and like, what do I do with this? Instead of spending it on something that's going to lose value over time, stick it in something that's going to gain value over time and still be yours.
Mhm.
So if you were to take that and say you've got 20 grand sitting around, start yourself a solo 401k plan under your business and go drop $20,000 into it.
Mhm. Well, that's huge. So one of the things that I go through, so we require reserves. We want to see that not only you put your down payment, but you're going to have money there to make your monthly payment after you acquire the property and fund the build and all that. So we require reserves, and it comes up a lot, and people and our clients go, well, I've got the down payment, I've got all that stuff, but I need this money for this. And I say, well, if you have a 401k, we can use that as reserves. And they go, I don't have one. I feel like, Tim, wouldn't you say that's majority of our clients? Like they just don't have a 401k. At least that's what it feels like. So sometimes they left a W-2 job and now they're self-employed. But yeah, no, that's a huge. I hadn't even thought about.
I would say very few people think ahead when, especially if they're younger, when they're trying to get a business up and running, they very few think ahead to start putting money in a 401k. I mean, the only reason I think most of us have ever put money in a 401k is because we've had our employer automatically deduct it for us. I
Yeah.
mean, and I think that's just human nature.
Yeah. You know what's really interesting, and you guys are in the business of loaning money out to people, but I don't want to ruin that for anybody. But something cool is if you build up enough money in your 401k, you can actually do a self-directed 401k and go invest your 401k funds into real estate
And
or
as
whatever.
long as we're on that topic, we welcome that, and you can invest in our fund if you have the right money. So yes, we
There you go.
we do that. With us operating a debt fund, we mention it. We're obviously in the mortgage business, but we're in the mortgage business because we have a debt fund, and we have a whole second half of a team that their job is to raise funds. So thank you for the advertisement. So
Yeah.
if you know anybody that wants to invest money, we will gladly park your money and invest it, locally in the Metroplex.
Yeah. And last thing about 401ks, because I'm not, we don't need to do financial advice or anything, right? But the really cool thing that you can do with a solo 401k, as a normal person, you're going to max out at about $22,000 of what you're allowed to put into your 401k. And your company, you're getting a W-2 from somebody, your company's maybe matching a couple percent. As your own small business, you can match whatever you want to match. And you can, instead of being capped at 22 grand that you can put in, you can put in about $66,000 between your company funds and your personal funds. That's going to go into your 401k, and it's tax advantaged. And if you happen to be married and you want to have your spouse on the payroll, you can double that, right? That's a lot of money that you can dump into a 401k that you can use for investing projects that you're going to have deferred taxes on it, right? I mean, it's a crazy kind of a strategy to do stuff like that. Just throwing it out there. Yeah, but okay, so let's talk about investing and the stuff that you guys do, where you're trying to get people money to go invest in real estate, right? And there's a bunch of different sort of classes of real estate that you'd be talking to, and there's positives and negatives to everything, right? So if you're doing fix and flips, most of the time that's going to be, single family homes, right? And you're going to end up paying the taxes on that. And a little while ago you mentioned capital gains, and it is capital gains, except if you sell it within a year, it's 365 days, right? If you buy it and sell it within that, your capital gains tax is just ordinary tax. There's no, it's called capital gains, but just because of the classification, but it's still ordinary taxes. So if you're in the 33% tax bracket for that year, you're paying 33% on your earnings that you made from your flip, right? When you're holding stuff, and as you get, later in life, maybe you don't have the W-2 income, or everything that you're doing is passive, it's a different kind of thing, right? And you're also taking advantage of depreciation. You can also, if you buy something that you're going to live in for a couple of years and then turn it into a rental, whatever you do with it after that, you could avoid a whole bunch of capital gains as long as you've lived in it for 2 years. So you can have some strategies out there where, hey, I'm going to do a fix and flip, but I'm going to live in it for 2 years. I'm going to sell it and make, $250,000 on it. But because I lived there for 2 years, I get to write off $250,000 worth of earnings by doing that. So there's a bunch of different ways to do this stuff, right? And if you can buy and sell something and make 60 grand in 6 months and just take that and go invest it and keep making money, and that's your income, awesome, right? Just know that your income is, you're paying regular taxes on the income for that stuff.
I think that's huge on that, because I didn't realize if it was sold under a year you did that, and then if you live in it for for 2 years, that I didn't know those were caveats, or
Yeah.
little niches that you could do different strategies with. So
Yeah. The tax rule basically says if you've lived in it for 2 of the last 5 years and then you sell it, for an individual, I think it's $250,000 in gains that you get to deduct. For a married couple, it's 500,000.
nice.
And yeah, so if you buy your first one, you're like, hey, I want to sell the place I was living in, or I'm going to buy this and stay here for a couple of years and then go sell it and try to make money. I fixed and flipped it for me, or I fixed it, I lived in it, and then I flipped it 2 years later, and you saved a bunch of money on taxes.
Yeah, that's awesome.
Yeah. But yeah, so and then there's different kinds of things when you're talking about real estate. So single family homes and multifamily up to 4 units are mostly considered to be the same type of thing, except the really convenient part about multifamily units is you can buy it, you can live there and also be renting it. And then it's super easy to get that 2 out of the last 5 years. And somebody's paying your mortgage for you because you can have 3 tenants living in the building with you. Right. So that's an awesome strategy for just somebody who is young and is looking to get into this. And you don't have any extra stuff going on in your life, right? Maybe you're not married, you don't have kids, you don't have anything tying you down to something. You're just like, hey, I'm gonna work my butt off to go take care of these 4 things that I own, and anything that happens, I'm right here. Hey, you guys come get me, I'll go fix it for you. I'm the landlord, I'm also here with you guys. And they don't need to know that they're paying every single penny of your mortgage, and you don't have a rent anymore, right? But you're building your asset and you're taking advantage of all of these different tax situations, because you're going to be depreciating the heck out of a building that's 4 units. It's great. It puts you in a great situation. And to start off, to be able to not have rent, which is it's the biggest draw on people's lives these days. Rent and taxes are the 2 things that just suck all of your money out of your life.
Mhm.
So it's kind of a cool idea. If you're just starting out and stuff, buy a little something that has a couple of units. You can live in one, have somebody pay your mortgage, and then when you're done living in it, sell it off. One of the things that I have on here is the 1031 exchange, which I'm in the fix and flip world, you don't get to take advantage of that as much. But in the buy and hold world, 1031 exchange is huge. It's a crazy advantage. You get to defer basically like all of the taxes on the capital gains. As long as you follow the rules, you can go sell this property, buy another property that's equal or more in value, and you get to defer all of the taxes on capital gains. It's an enormous strategy. So you think about somebody just starting off in real estate, and they go buy one of these small multifamily units. They're covering their rent. They're building equity. They live there for a couple of years. They sell the thing off, 1031 exchange it into an apartment building, right? And now they've got 16 units and they haven't paid any taxes and they haven't paid a mortgage or rent payments for years
Mhm.
now. And now they've built this asset. It's crazy. There's so many awesome strategies and things you can do with this stuff.
Definitely. Yeah, that's exciting. All right.
Sorry,
Uh,
I enjoy these things. I
No,
can
I know
talk if
it's
I talk
great.
too much.
And I'm sitting here as we're going through this, I'm like, oh, this one of our clients needs to hear this part, and this one needs to hear this, and this one, and I'm just sitting here going, they may not be on, but when we get this uploaded to YouTube, I'm gonna say, hey, you need to come watch this. So
Yeah.
no, it's awesome. And uh, side note, my dad worked for the IRS for 35 plus years, and my father-in-law is a CPA for a large business. So my dinner conversations over the years have been tax strategies, more
Yeah.
often than I feel like the average person. But I'm learning lots. I'm learning lots. So because it's never been a conversation that was directed at real estate since neither my dad or my father-in-law were in real estate like this. So,
Yeah. It's awesome, man. I have so much fun helping people through this stuff. Really. Yeah.
all
Okay,
right.
so asset protection. Yeah. I mean so that's another part of why you're starting a company. It's another part of why when you buy your first thing, you're gonna put it in an LLC because you need to protect the assets that you're building. And depending on the situation,
Mhm.
you're going to be protecting the assets from you, and you're going to be protecting you from the assets, right? There's two things. So when you think you make an LLC, you're going to put a piece of property into that LLC. What you're trying to do is make sure that, you know, heaven forbid something happens to that house and it blows up and it kills 3 people and you're on the hook for $3 million worth of liability, right? Like, how do you protect yourself from that? How do you protect yourself from contractors? How do you protect yourself from tenants? There's You put all of your hard work and all of your money into getting this asset. How do you make sure that it can't come back and destroy your life, right? Something happens and it's just the worst possible scenario.
Mhm.
So that's a big part of why you want to have these business structures. And the kind of general rule out there is for all the different, like anytime, what a lot of people do is anytime they're going to go buy a new property, they're going to start a new LLC for it, and they're going to stick that property in that LLC. And then they go buy another one, they're going to have another LLC, and they're going to stick that property in that LLC. And the idea of that is to make sure that if something happens to this one, it's not also happening to this one, or it's not also happening to you, right? There's some things that you can't necessarily protect from. Um, So when you think about, okay, I've got all these LLCs, I'm the owner. Say I'm in a car accident and, something terrible happens and all of a sudden I've got a couple $1 million worth of bills and my car insurance is only covering up to $1 million. So I owe people $4 million all of a sudden because of a car accident. Happens to everybody every day, right? Well, you own the LLCs. So if somebody's gonna come after you for $4 million, well, they're gonna come after the stuff that you own, which is your LLCs. Just because your LLCs own the property, you own the LLC, you're still connected, right? So it's when you start getting into the world of asset protection, there's some stuff that you really have to start thinking about. And the LLC is the bare bones what you should do to start protecting your assets. The other thing that we recommend to people is when you're starting your LLC, don't put your name on it. And I think this is particularly true for people who have rental properties, is you could go onto the Secretary of State's office right now and look up the company and find the owner of the company and their home address. And if you've got a tenant and you're doing rental properties, and maybe you don't want the tenant to know anything about you, you hire a management company and they handle all the stuff. But your tenant could just show up at your front door because they're like, hey, this LLC says, Joe Smith. And I looked up Joe Smith, and here's the address for Joe Smith. And you walk up and you're like, hey man, what can we do about my rent? You don't want to be in that situation, right? And it's a similar kind of thing when you think about creditors or you think about contractors, like, how much of my personal information do I want people to have while I'm doing this business? There's some things that are unavoidable. It's all how you structure things. But you want to have some anonymity going into this stuff. So don't have your LLC be Joe Smith Enterprises, because they're gonna find you. You're Joe Smith, right? And there's other layers that you can put into it. So anonymity in LLCs, that's the first two, and it's the easiest layers that you can put in. If you're really worried about this stuff, or you really start to build a portfolio of assets, you might want to have some extra layers in there. So COPE stands for Charging Order Protection Entity. And it's available in a number of different states where if there is something that happens against your particular company, they're only able to attach to that particular company. And so, a judge might say, hey, you owe so-and-so $1 million. Any money that comes out of this thing, you have to give right to them. And you say, okay, well, I have charging order protection. I'm just not going to take anything out of it. And then they're not going to get anything out of that company, right? So you could have your property keep going and keep, creating income in itself. And as long as you don't touch it, then nobody can take anything out of it, right? It's a different kind of layer of protection. And that's the same thing with having trusts, because you get to a certain point, you say, hey, I've got a bunch of stuff. I need to have a trust. The trust needs to own this thing, this thing, this thing, this thing, because if something happens to me, I got to make sure that my family can take on all of these assets in the right way. So yeah, so there's a lot of stuff about asset protection, and it's really pertinent to real estate because this is what you're doing, right? You're building assets. You might not worry about more than your LLC on the first one or the first 5. But you get to a certain point and you say, okay, listen, I need to keep some of my information to myself,
Definitely. All right, Tim, you want to get to the next slide?
Yeah, hit us, Tim. Real estate professionals, yeah. Okay, so what's cool about real estate professionals is if you're able to do these things, the big advantage of investing in real estate is you get to take the depreciation, you get to take probably on paper losses when you're doing some of these things. But those losses are passive. So for most people to be able to use up passive losses and save on taxes, you can only put it against passive earnings. So maybe you have one piece of property that is losing money on paper, one piece of property that's gaining money on paper, and maybe you can use those to offset each other. Or you have one piece of property, you're going through depreciation, you've got lots of expenses, you're able to show on paper that, say, you lost 10 grand last year. Well, you can't use that 10 grand against your W-2 income. It doesn't work that way because it's ordinary income versus passive income. And the really cool thing that you're able to do if you're a real estate professional is you can mix those two together. So you can take passive losses and put it up against ordinary income. And then you get the most out of your real estate tax strategy. So it's really neat that real estate professionals are able to do this. And it's a big reason of why a lot of people who start as real estate agents invest in real estate, because it's a special situation just for them. And you can actually, anybody can be a real estate professional. You don't need to go get a license to be an agent or broker or anything. You can be a real estate professional as long as you follow a few rules. And I'm not saying these are easy, and it's not something that you can do if you have a day job, probably. But the rules are these. You have to spend more than half of your time on real estate projects. That's a big ask for some people. If you've got a W-2 and you're spending 2,000 hours a year on your W-2, it's going to be tough to spend 2,081 hours also on real estate. That's a tough thing to cross, right? But if you're mostly retired and you're working, a couple hundred hours a year on a W-2, you can probably pull this off if you're spending a lot of time in real estate. But you got to do all three of these. So the next one is it has to be at least 750 hours. And that 750 hours has to be more than anybody else. So then again, if you get into a situation where I have some rental property, for instance, I'm going to pay somebody to go manage that rental property. They might be spending a lot more time on the property than I am. So in order to get this classification, I got to spend more time than anybody else did. And it has to be at least 750 hours. And then the last part of it is material participation. So if you're spending this much time on everything, you're probably going to get there anyways. But material participation is basically just saying, I'm doing some of the work for this property to create income for me. If you can qualify under all of those things, you're in an amazing tax advantage situation, because on paper, you can get most long-term real estate to show as losses. And if you do that and you put it up against your regular earnings, you could have years where you're not paying any taxes at all. And it's just because of paper and because of this strategy. So it's really cool stuff to be able to do this. And, and my thing right now is with the changes in Texas specifically, there's never been a better time to be a real estate agent and be investing in stuff and having your own business. It's a fantastic year for people to be doing this.
Definitely. And yeah, learning lots, and it makes you wonder who's going to actually check if you're doing at least 750 hours, but I guess they'll kind of know.
You got to document it all, because
Yeah.
it's one of the things that the IRS will have people look at.
Yeah.
Yeah.
That's what kept my dad employed for years.
Yeah, I know it. And now they got 87,000 more IRS agents. So
Yes, that's right. So, Well, this has been extremely informative. If there's any last questions, I know we kind of asked them as we came up, but if anybody wants to throw it into the chat box, we can. Or if Tim, if you have any that pop up or that you've thought of that we haven't covered, we can do that. But no, this has been awesome. Like I said, taxes has been one of those things that comes up a lot in the conversations. With my father-in-law being a CPA and CFO and those sorts of things. But no, this has been informative. I learned a handful of things, and like I said, I'm definitely, sometimes our top clients are out building their homes or remodeling, so they don't always get on these webinars. But there's a couple of them that I know I'm going to say they have to watch this as homework before I'll give them another loan. So no, this has been
Yeah,
awesome.
definitely. Yeah. And this is the kind of stuff that I love helping people with. And we will set up entities for people. We'll put your whole strategy together. Like, hey, you're going to do this thing. Okay, here's where your assets are. Here's what you can do with it. I love this stuff.
Mhm.
Clearly, I could talk about it all day, honestly. Yeah,
Well,
but if anybody needs help setting up companies, setting up accounting stuff, figuring out what the strategy is going to be, I do it all day. So feel free to give me a call.
So, and then just to kind of recap, your ideal, I mean, obviously you do this type of strategies for multiple different backgrounds, whether it's real estate or, other types of self-employed people, but your ideal client is who?
So we like people who are getting started and to sit down and say, okay, I've had a certain degree of success in my life up to now. I don't know what the next thing to do is. Should I go buy real estate? Should I go buy a bunch of stocks? I'm gonna make a bunch of money this year, so I'm gonna have to pay taxes. How do I not do that? It's the most fun for us, for people who are right there, and you're like, I'm gonna do something different. I'm gonna do something that's gonna be fun and lucrative for me, and I don't know quite what the next steps to take are. That's the best. I love those.
And I like that you want to start them from the beginning instead of when they're 3 years in and you got to restart because they set themselves up wrong. You didn't say it, I said it for you because that's kind of what I figured. But no, that's great. So for you guys online, obviously he's got his contact information there. They're right here down the street in Allen, which isn't too far from us here in Plano. So yeah, if you have questions, Ryan's made himself available. He's got his phone number, email address, and schedule it times. Obviously, like he said, he loves talking about it. You can tell he gets excited. So reach out to him and go from there. I didn't have any additional questions pop up on my end. And then just the last thing, I have my information there also. Ryan's information is there too. So if you have questions, reach out to Ryan or I. And no, it's been a pleasure. It's great to do this, and we'll put it up on YouTube in the next day or two, and go from there.
Awesome. Hey,
right.
Jeff, Tim, it's been a pleasure talking to you guys.
Definitely.
And hopefully there's some tidbits that help some people out there.
It's been great. It's been very educational. Actually, you did a great job with it, and I apologize for my delayed responses. I have to keep finding the unmute button.
All right. Well, great. Well, everybody enjoy the rest of your Wednesdays, and we'll see you next time.
Awesome.
All right.
Bye, everybody.
Bye.